Hello, my name is Tommy Lampini, and this video is for people who want to learn about the basics of investing. I'm making this for my friends or family that want to just get a basic knowledge of investing. Let me just point out that investing is not difficult. You could make it seem difficult if you delve into all that is all the details, all the metrics, all the analyses of investing. But it's really not as difficult as some might make it out to be. You will find a lot of financial analysts and money managers that will throw all kinds of statistics at you and to scare you into thinking that you can't invest on your own, that you need them and you need to pay their commission for you to invest wisely. But it's really not true. You can invest on your own. You can do just as well as the experts, and in some cases better, since you're not paying their commissions. I have 5 basic investment rules, and let me go to there right now. The first one is buy low, sell high, and that's I'm sure you've heard that before. It's pretty basic. If you buy when the market is below its initial real value, you're really buying it on sale. And just like when you go to the store, you want to buy things on sale. You're getting better value for your buck. The problem is when the market is down, that's when people panic and they don't want to buy, because there's that feeling that if the market has been going down, it's going to continue to go down. So there's that feeling that I don't want to lose any more of my money. So what people tend to do is when the market's going down, they tend to sell so they won't lose any more of their money, and that's really the opposite of what you should do. And conversely, when your investments are doing well and the market's doing well, people tend to think, well, I want to get on the wagon, and the market's doing well. I want to make money and make more money, and so I want to put my money in the market because it's doing well. Well, that's not the right thing to do either, because when the market's doing well, sometimes it will be higher than its real value. And just like you don't want to buy things at the store that are priced over their real value, because you're not really getting a good value. So the most difficult thing to do for investors is to buy low and sell high. People tend to do just the opposite. Number 2 is risk-reward relationship. There are all different types of investments that you can make, and there's certain risks associated with each one of those investments. There are things called growth stocks that are considered high risk. Like, for instance, you could have McDonald's, and back in the 60s it was considered a growth stock because it was just starting out. It didn't have the footprint that it has now. So back then it was considered a growth stock and a risky one as well. IBM in the 60s was a growth stock. Microsoft in the 80s and Apple in the 80s were considered growth stocks. Well, look at them now. Doesn't mean that all growth stocks are going to do as well as they have. They're the exceptions, but there's still a risk there. You can think of stocks that aren't as risky, like, stocks like ExxonMobil or Merck or Walmart. These are what they call blue chip stocks or large cap stocks that are have been around forever, and they have been making money forever. They pay dividends. They're lower risk, but they're not going to triple in value in 2-3 years, like some growth stocks may. So the basic rule is, if you have an investment that's high risk, it probably will give you a high reward, and the chances for a better return are greater. And the low risk stocks will return lower than high risk stocks, but it all depends on your risk tolerance. And it's good to have a mixture of both. Number 3 is time horizon. Your time horizon is, think of as, when you need your money. Like, for instance, if you have a child that's 10 years away from going to college, that's your time horizon, 10 years. So if you want to put money away for him or her for college, you have a 10-year horizon. 10 years, you can afford to be a little risky and get into some riskier investments because they will tend to do better over 10 years. And as you approach those your horizon, you're going to want to reduce your risk and get into less risky investments. Like when you're at 2-3 years to the point where you need the money, you're going to adjust your investments to become less risky and maybe invest in those blue chip large cap stocks. It works the same way with retirement. If you're 30 years old and you're 30 years away from retirement, you want to get into more risky investments because you want that higher return. They're going to be more volatile. You might find them out after 1 year, they might lose 30% of their value, but they will tend to rebound from that. But since you're not going to need that money in 1 or 2 years, you can deal with that volatility. So again, the rule here is your time horizon. The longer your time horizon, the riskier you can be. Shorter, the less risky you want to be. Number 4 is interest rate bond relationship. We have a relationship between risk and reward. We also have a relationship between interest rate and bonds. What you'll find is when the interest rates are high, that's when the bonds have the best value. That's when the bonds tend to do the best, when interest rates are going up. And back in the early 80s, the interest rates were double digits, sometimes 12, 14% in some cases. And since then, they've been going down to where they are now. They're at historic lows. So essentially, we've been like in a bull bond market over the past 30-some years. You might think that because interest rates are so low and they can only go up, that bonds are not a good value right now. Well, that's kind of true, but you can still invest in bonds if you want to diversify your investments, and that's the best thing to do. It's a good idea to have a mixture of stocks and bonds and other investments. If you're going to invest in bonds when the interest rate is this low, you're going to want to stick with short-term bonds. Don't worry about not knowing what short-term bonds are all about. Just understand that bonds have a metric associated with them, which is called duration. A duration of less than 5 years means it's a short-term bond. If you're going to invest in bonds with the interest rates this low, you want to stick with short-term bonds. And so if you invest in a bond mutual fund, you'll find information on that mutual fund. It'll tell you what the duration is for that mutual fund. And if it's below 5 years, then it's probably a short-term type bond mutual fund, and that's really what you want to look at. Also, you'll find mutual funds that invest in a mixture of stocks and bonds. You also find that this duration on the information for that mutual fund. And again, you want to stay around below 5%. The number 5 basic rule is diversify. That's really the general rule. You don't want to, quote, put all your eggs in one basket. You want to get a mixture of stocks, bonds, and what they call real estate investment trusts. And you don't really want to get into commodities or options or things like that. You really don't want to mess with that. It involves you to spend more time researching it and keeping an eye on everything. This is just basic. You want to put your money in a mutual fund that's either that has a certain amount of risk and time horizon, and you don't have to worry about anything else. So you want to make sure that there's a good mixture of stocks, bonds, and maybe real estate investment trusts. You can invest in a mutual fund that has this type of diversity. You have mutual funds that are called balanced mutual funds, and they will have a mixture of stocks and bonds. And in this case, a lot of times the mutual fund manager will have a mutual fund that's maybe 30% bonds and 70% stocks. And if the market is overvalued, he or she might rebalance that mutual fund so it's 70% bonds and 30% stocks, because when stocks are considered overvalued, he will maybe rebalance that. So when you get into a balanced mutual fund, you'll have the mutual fund manager doing that rebalancing. You won't have to. So that's where we are now, the 5 basic rules. Now, one thing you should probably learn is stock market indexes. You've heard them talk about the Dow, the Nasdaq, and the S&P 500, which is called the Standard & Poor's 500. These are what they call indexes. The Dow is an index of 30 blue chip stocks. Example, General Electric, Walt Disney, ExxonMobil, Microsoft. Some people will invest in an index fund which parallels the Dow. In other words, it invests in all 30 of the stocks within the Dow. And it's called an index fund. It's not actively managed, which isn't a bad thing, but you're getting a good mixture of high-quality blue-chip stocks. You also have the Nasdaq, which is an index of mainly technology-related stocks. For example, Apple, Microsoft, Amazon, Intel. This is a more volatile index, but along with this volatility, it probably is in the category of high risk, high return. Okay, so if you wanted to, for example, have a balanced stock mutual fund, if you invested in these 3 indexes, Dow, Nasdaq, and S&P 500, that's pretty balanced. Dow is probably the more conservative of the 3. Nasdaq is the more aggressive, and S&P is somewhere in between. S&P is a very popular index because it has 500 stocks, and they're all what we call large cap stocks. They're very big, and they usually pay dividends. So, for instance, when you hear somebody say the market is doing well, they're usually talking about the S&P 500. Or if they say, did your investment beat the market? They're usually talking about the S&P 500. There are other indexes like the Russell 3000, which includes 3,000 of the best stocks. But for now, just understand these are the 3 major stock indices, and of these 3, S&P 500 is probably the more popular of the 3. Okay, this is some more information about the 3 indices. You'll find that many people invest in the S&P 500 index, which is a mutual fund that invests in all 500 stocks in the S&P 500. that's a pretty good investment. And you'll find that over the course of the life of the S&P 500, it's done pretty well. It's returned about 7% annually, which is a pretty good return. Every 10 years, that means every 10 years your money will double if it stays at 7%. There is some volatility in that, like, for example, between the years of 1950 and 1965, the market performed very well, but from 65 to 80, it was relatively flat. So you're going to have different cycles, but over the long term, the S&P 500 is going to do well for you. When you look at mutual funds, and when you research mutual funds, you'll see this little box here. And it looks almost like a strike zone for you baseball fans. You'll see a little circle. If you look at a mutual fund, it'll show a circle and it'll tell you the style of that mutual fund. This small, mid, large refers to small cap, mid cap, and large cap. And what they are, it's called market capitalization. Market capitalization represents it is really a metric of the number of shares of a stock multiplied by the value. So, for instance, if there's a stock with a price of $100 a share and it has 100 million shares outstanding, well, then the market cap is 100 million times 100, which is 10 billion. Large cap stocks have a market share of 10 billion and greater. Mid cap stocks have a market share of 2 billion to 10 billion. Small caps have a market capitalization of 2 billion and less. And this is just a way of pigeonholing different stocks. And it doesn't really tell you the value of the stock or the health of the company. It just tells you essentially how many stocks they have and the worth of the stock. You will find also value, blend, and growth in the vertical column, in the vertical columns. And when you see this, you'll see on the far right, which is growth, which means that a company is relatively small. It still has room to grow. On the left side, you have value, which usually means a stock or a company is large and their stock is underpriced or on sale. Blend is a little bit of both. So mutual funds have a style of investing. If you have one down in this lower quadrant, small growth, you're talking about a small company that has room to grow. Now, this square will probably give you the highest return, but in turn, it'll also give you the highest risk. The opposite corner, large value, is a large established company that is underpriced, and you can buy on sale, essentially. So this square probably has the smallest risk, smallest return. This square, larger risk, larger return. Now, a lot of financial analysts will tell you that the best bang you get for your buck is this little square up here. You have companies that are established; they're not going to go out of business. Their stock price is on sale, so the value of the company is greater than the stock price. So just like when you buy a car, if you know a car is worth, say a used car is worth $10,000, whether it be like a Lexus that's a couple years old or whatever. If you know that car, say the Kelley Blue Book value is $10,000, and you have a guy who wants to sell it for 8,000, well, you know, that's going to be a good buy for you. You know, you're really buying the value. You're really buying that car for a better value. And this is what this square represents. So that's really what you need to target. But if you are looking for a better return and you have a higher time horizon, you might want to find mutual funds that are down here, because over the long term, they're probably going to do better than mutual funds that are up here. Bottom line is, you want to really diversify. And if you're going to have 3 or 4 mutual funds in a portfolio, you don't want all of them to be up here. You don't want all of them to be down here. You want them to be mixed. Maybe 2 up here, large value, and maybe 1 in the center and then 1 down here. But you do want a mixture, and that will give you the diversification that we talked about. Okay, here's a review of what we were talking about. Large cap stocks of a market cap over 10 billion, mid cap between 2 and 10 billion, small cap under 2 billion. That just gives you an idea of what the company's stock is worth. Again, this talks about the value, the blend, and the growth. And this refers back to the strike zone that we have here. Here's a couple of paragraphs that I copied out of a book by William Bernstein, who is a very popular financial author, and he's written many books on investing. Very intelligent, knows what he's talking about. I'll just leave this here, and I'm not going to go over it or read it, but if you want to pause it, I would pause it out and read this, and this will really tell you what you need to know about financial analysts and why you should think twice about paying a financial analyst or money manager to manage your portfolios.